Hi dreamers! People ask me all the time about higher yielding options that I like, including CEFs or closed-end funds. Now as you know, I'm a long-term dividend investor, but at times I do try to augment this strategy with some ETFs and other investment types in smaller amounts and maybe with shorter term windows when I see opportunities or want to experiment. I think of it like dividend stocks are my main course, but from time to time, I may add these for dessert. So today I'll review 6 ETFs I've been researching lately that are all above a 5% yield. Let's do this. Okay, so the first one we're going to go through is SPYD. This one is not a closed-end fund. It started in October of 2015, has a nice expense ratio of 0.07, a nice yield of 5.89. It pays out quarterly, has a good beta of around 1, a 3-year total return of 8.7, and a 1-year total return of over 10%. It focuses on large value, and it pays dividends and is passively managed. Now this one only has a Morningstar rating of 2, and essentially it tracks the performance of the S&P 500 High Dividend Index. So if I take a look at this in Fidelity, you can see that it pays out in all dividends in green, but the payouts are uneven, which I don't necessarily like. When I go to composition, we can now see why it's so high of a yield. Essentially, the composition is made up of mostly oil, gas, crude oil companies. And you can see my note here that it's heavy in oil and pipeline companies. So for me, that part is a negative. Right now, oil and gas companies are rising, and that may continue to happen over the next year or so. But in my opinion, over the next 5 to 10 years, that is another bubble that's going to pop as we move as a society towards more environmentally sustainable energy options. So let's move on to the next one. QQQX. This one is a closed-end fund. So before we go any farther, let's talk about what a closed-end fund is. Essentially, it's a type of mutual fund that issues a fixed number of shares through a single initial public offering. Those shares can be bought and sold on a stock exchange, but no new shares will be created and no new money will flow into the fund. In contrast, an open-end fund, like most mutual funds and ETFs, accepts a constant flow of new investment capital. And you can see some of the pros and cons of closed-end funds here. On the pro side, diversified portfolio, professionally managed, transparent pricing, and the big reason to even think about these is the potential for higher yields. On the con side, more volatility and less liquid. So back to my analysis here. QQQX. It's a closed-end fund, and it's been around a while, since 2007, which you know I like. Whenever there's a fund that's been around for a while, you have the ability to take a look at historical returns, the kind of turnover with the fund, and the longevity of the fund manager and their experience. So QQQX has a nice low 0.9 expense ratio, a nice high 8.10 yield, pays out quarterly, an okay beta of 1.2, a 3-year total return of 12.21, a 1-year total return of negative 8.5%. The focus is large growth companies, and the investment style is derivative income. Now Morningstar gives QQQX a 5, which is great. And when you read about it, you learn that QQQX is focused on the NASDAQ, seeking to substantially replicate the price movements of the NASDAQ 100 index. This fund invests in software, semiconductors, semiconductor equipment, tech hardware, automobiles, biotech, etc. Now, as we know, the NASDAQ has been beat up lately, so QQQX is getting the rating of a buy as those baskets of stocks start to turn around, and as the ability to write call options becomes clearer. As I look at it in Fidelity, a good reminder is to look under the distributions and expenses tab, where you can see that these distributions have 0 dividends because they would show up in green. Instead, the way you make money with QQQX, just like the YLDs, is totally return of capital. Hence my note here, no dividends, taxes are all ordinary income. So that's just something to be aware with things like QQQX. High yield, and therefore potentially high income, but you're going to want to hold this in a retirement account. Okay, let's move on to the next fund. The next one is BST. It is a closed-end fund. It started in October of 2014. It's got an expense ratio of 1.05%, which is high. It's got a nice yield of 8.09. It pays out monthly, which is fantastic. A beta of 1.1, which is okay. A 3-year total return of 12.47, and a scary 1-year total return of negative 30%. It focuses on large growth companies, and the investing style is derivative income. So the focus here is US and non-US science and technology companies, and they're using a call and put option strategy. So as I look into the BlackRock Science and Technology Trust Fund, BST, they're rating this a strong buy. And as we all know, growth stocks have been hit hard in 2022, but you can start to see something interesting here at the very end, that there's resistance and we're starting to see an upward trend. So if I look over 10 years, you can see this fund going up and to the right with that bubble happening here more recently, and now the potential to start to recover. Going into distributions and risk, you can see that there's a hybrid with dividend payouts and long and short-term capital gain. And the top holdings for BST are Apple, Microsoft, Marvel, Alphabet, MasterCard, etc. So what I like about BST is that it's a hybrid of dividend and capital appreciation in addition to call options. It's been beaten up pretty badly and might be at the bottom ready to rebound. So there's a few things I like about BST. Okay, let's move on to the last three. NBB is another closed-end fund. It started in April of 2010. It's got a very high expense ratio of 1.37, a nice yield of 6.91, and it pays out monthly, and a very nice low beta. The 3-year return is very low at 1.75. And the 1-year return is even worse at negative 14.4. Now this one is fixed income. It employs a long-term bond strategy. So essentially this one creates income through investing in taxable municipal securities. Now I've been staying away from long-term bond funds because they're subject to inflation risk. So this one's come up on my radar a few times, but I've tended to stay away from it just due to the inflation issue. So those are some things to note if you're considering NBB. Let's move on to UTG. UTG is also a closed-end fund, started in 2004, has a pretty high expense ratio of 1.23, a nice yield of 6.76, pays out monthly, really nice beta of 0.7, 3-year total return of 5.36, and a 1-year total return of 2.52. They focus on large value, and it's a combination of dividend income and capital appreciation, which is nice. Morningstar rating of 3, which is not bad. And when you dig into this one, you can see that it's focused on electricity, gas, water, telecom, and other infrastructure income sources like airports, toll roads, and municipal services. So it's not hard to see why that beta is so low. I actually kind of like UTG. I just wish that expense ratio wasn't as high as it is. So let's finish this out with XYLG. This one is not a closed-end fund. It's relatively new, starting in September of 2020. It's got a low expense ratio of 0.06, a pretty good yield of 5.77, pays out monthly, but like any fund that's relatively new, it lacks long-term data. The 1-year return was 3.17%. It focuses on large blend. It's a derivative income style, and there's no Morningstar rating. Now, in my last ETF video, I covered the YLDs and why I wasn't really a fan. And if you do research on the YLGs, you might come across something like this, that they're hybrid funds generating income and growth, and that they're the cousin funds to QYLD and XYLD. And the reason why I like these better than the YLDs is echoed here in this article, that essentially they use a 50% covered call strategy so that they generate income but also recognize capital appreciation gains. It goes on to say that Global X came out with these two hybrid funds to provide income without sacrificing all the gains of the market's experience. So they only write covered calls on 50% of the portfolio. And it goes on to say that after this particular analyst's research, that after reinvesting dividends, QYLG generated more income, but the capital appreciation from XYLG provided a larger ROI to shareholders over the time period of October 2020 to January 2022. So I think that makes XYLG an interesting one to put on the list. So given all of that, what will I do? Well, for SPYD, I probably will not invest here. And the reason is because I'm just not a huge fan of the heavy oil and pipeline company composition. But I tell you what, that low expense ratio and high yield makes it very tempting. I kind of do like the idea of QQQX, maybe as a short-term strategy. This I would tread lightly and maybe put just less than 1,000 here and definitely hold inside of a retirement account. Now I do quite like the idea of BST. This one's got a lot of things going for it. It pays monthly, has a nice yield, and potentially there's a bottom that could provide some nice growth. It is a hybrid of dividend and capital appreciation, and the only thing I don't like is this expense ratio. But this one could be an interesting shorter term strategy for me. And when I say shorter term, I'm saying maybe 1 or 2 years to 4 to 5 years. For NBB, I'm gonna continue to stay away from long-term bond ETFs, simply because we don't know how long and how high this stretch of inflation is going to be. And to finish up, UTG. I'm kind of on the fence with UTG. It's right there. I mean, 6.76 yield, it pays monthly, got a good beta, but the high expense ratio is really something I'd have to think about. So I like this one, and I'll put it on my maybe list. And in terms of XYLG, I'm also very much on the fence here. The number one thing I don't like is how new it is. So I'm going to continue to watch these YLG funds and just monitor as time goes on. So I'm putting XYLG on my maybe list, but more in the don't like column. And there you have it. All right, thanks for spending time with me today. Remember, high return always means higher risk. While I may be having these for dessert, it will be with a smaller percentage of my total portfolio. As always, I encourage you to do your own research, then implement and learn by putting it into practice. And as a reminder, I'm not a financial advisor, so keep in mind these videos are for entertainment and inspiration only. I'll see you on the flip side.